Good morning, good afternoon, good evening, wherever you may be. This is Sid from ElliottWavePlus.com. And this is the October 10 of 2023 edition of my quarterly premium plan webinar, where I invite the world to come in and take a peek at what we do here at Elliott Wave Plus. And the reason it is called the premium plan webinar is because the premium plan includes absolutely everything that we do for our subscribers. So before we get started, I would like for you to be aware of my disclaimer. And I'll bring it over here. So to read my disclaimer in full, please go to my website, which is ElliottWavePlus.com, and scroll down to the bottom of any page on the site, and you will see this footer section down here. And so you would need to click on the Terms of Service Disclaimer tab. And there it is. It's there all the time. So please go there and read that in full. If I were to summarize it in one sentence, it would be there's a risk of loss in all trading. Also, since we'll be talking about automated algo signals quite a bit today, I also want to point out some of the verbiage that's additional verbiage that's in the disclaimer, and that is that past performance is not indicative of future results. That is something I'm required to put into my disclaimer by the authorities. While we're at the site, just to familiarize, I would like for you to familiarize yourself with the site, if you would, please. It is ElliottWavePlus.com. It's going to go back to the home page now. Now, I happen to be logged in right now, and so you can see the whole screen. I'm going to take off the little video screen of myself in the upper right-hand corner from now on in the webinar. And just the construction of the website, if you are not logged in as a subscriber, so if you are not a subscriber, you would not see these headings right up here. You would see the resources headings, which shows pages for our videos, our educational guides, and our blog. And by the way, the recording of today's event will be posted on our blog. And then also you can look at your account and which level of service you are subscribed to if you are logged in, and see these words up here. I can tell you, if you are not a subscriber and you'd be interested in looking into subscribing, you go down to our subscription services. You can see we have 4 tiers. Now, I'll let you go to the website and read in depth about the 4 tiers, but I'm just going to choose one. By the way, these 2 tiers here, the weekly webinars tier and the EWP screenshots tier, are by far the bulk of my subscribers fit into those 2 categories. And then you'll move to a page that describes everything that is included in the cheapest tier. It's the Trend Reports tier. And the only Elliott Wave counts you would receive for $25 a month if you subscribe to the cheapest tier would be on Bitcoin. So I do not recommend that tier. Now, if that tier is all you can afford, then by all means, give it a shot. There is some useful daily trend information there. But if you're really looking for Elliott Wave counts Then you need to go to the basic plan, which is $70 a month at a minimum to this level. And then the next level is $100 a month, and it is the webinars plan. It includes everything that's in the basic plan, all the screenshots on Wednesdays and Sundays, but it also includes a live invitation and availability to a recording afterwards of my weekly webinar, which I do on Sundays, where I take about 2.5 hours to explain everything that's going through my little head about the markets. And then the $200 a month plan has everything that's I just described, everything that's in the lower price plans, but it also includes two very important additional things, and we'll be talking quite a bit about those tonight. And that is automated momentum trade signals on about 20 plus different items. And also they receive access to our proprietary sentiment conditions screenshots on all of these items that are futures contracts. And the reason they would have to be a futures contract is because that is the only place where you can receive sentiment data on commercials positioning, as well as a retail positioning. And my sentiment conditions screenshots key on those two things and are able to pinpoint some extremely important turn junctures in the markets, and are doing an amazing job of that over and over again. But notice, no matter which of these you are interested in looking at the pricing on, when you hit pricing, the pricing button, that goes to the following page, which is elliottwaveplus.com/pricing. That's how you get to this page. And it explains the different levels of service and what are included. And so if you have any questions at all about which service would be best for you, you'll want to get to this page. If you're interested in seeing Elliott Wave counts on lots of items, but don't want any more than that, then this is where you want to go, the basic plan. If you want to pay an additional $30 a month to have me explain far more in depth than just looking at screenshots, then it's $100 a month. And if you want the sentiment conditions as well as the automated momentum algo signals, it's $200 a month. I know of no other service that provides as much information and looks at the markets in as many different ways as our premium plan. And I think you'll get the picture on what I mean by that as we move through the webinar. So I am subscribed as a premium plan subscriber. So I get to see under the screenshots tab every Sunday and Wednesday set of screenshots. And the number of screenshots that we take and make available on Sundays is typically around 120. And on Wednesdays, it's over 60. So we leave out some of the real long-term charts on Wednesdays. So like no monthly charts or quarterly charts. We stick with a shorter term. So you get basically a shorter term update on Wednesdays on as a supplement to the all-inclusive, including the longest term charts that you get on Sundays. So that's screenshots. Webinars. Every week we record a webinar. There's you get 2 recordings of it real quick. You get the Zoom recording of it, and you can see that Sunday's webinar was 2 hours and 44 minutes long. And then usually a couple of hours after that, approximately, we'll put this recording rendition of the recording of the weekly webinar up, which allows you to hit these right here and jump directly to my coverage of specific items. So if you're looking for gold and silver, you can click on that and look at my very quickly jump to the gold and silver wave counts, so on and so forth. And so that's under the webinars. And then under nightly reports tab, if you're on the cheapest plan, the only thing you're going to be able to see are the daily trend reports at $25 a month. And that the daily trend report consists of trend charts that show you the daily trend on about 20 different items to the daily trend direction. And then you also receive access to crypto charts, which include my Elliott Wave count on Bitcoin, as well as automated trading signals on Bitcoin, Ethereum, Litecoin, and Ripple. We're just about ready to start talking about the automated screenshots. We'll get there in just a sec. And then if you're a premium plan subscriber, you see everything that I have been showing you, just as if you were me. You get all the screenshots, the webinars, the trend reports, and the nightly algo report. Here's tonight's version. And what the nightly algo report shows is, if it would be so kind as to bring it up, it shows a number of screenshots on a number of tradable items, over 20. So, and those 20 items have both something that, like, here's the Australian dollar. You can see it's on a buy signal as of the end of the day on Monday, Monday. And it shows you where the stop is, and eventually it will end up telling, these are nightly reports are put out every night. It'll show when there is a loss of momentum and when to exit. And in this particular case, it uses a trailing stop. Before it exits the trade, it is likely going to, at some point, warn you to tighten your stop up and start trailing the stop. So and then in addition, on the Australian dollar, in this particular example, you get sentiment conditions screenshot, and premium plan members get this every night. And you can see, and I'll explain this in depth in just a minute, that the commercial traders are all heavily long the Australian dollar, while we're just very recently off of an 8 DSI. DSI stands for Daily Sentiment Index, and that means that on that date, that green triangle right there, only 8% of retail traders were bullish. Whenever you see that few of retail traders that are bullish at the same time as commercials are all heavily long, that is a very important, we call it here at Elliott Wave Plus, it is a perfect storm of bullishness. So I'll explain how to read these charts a little better here in a second, but also notice that seasonality is shown on this chart. So in the case of the Australian dollar, we're in a period of bullish seasonality that started on October 6th and ends on October 20. That means most years the Australian dollar goes up during that period of time. And so far, so good. So all systems are go as far as that chart is concerned. And so when we move back to the list of items, there's a bunch of them here: Australian dollar, Canadian dollar, crude oil, German DAX, Dow Jones Industrial Average. We throw in not an Elliott Wave count, but a sort of a daily trend report on Dust and Nugget, and the 2 times leveraged gold miners. And EEM, the Euro, GDX, gold, KBE banking, in the NASDAQ, and then some leveraged ETF ways to play the NASDAQ and the Russell and the S&P, US dollar, XLE, large cap oil stocks, ETF, and bonds. We use the 30-year bonds, CB contracts. So all those things are included there. And then right at the top is a PDF that is a report on the evening of any new action items. For instance, tonight's report gave a buy signal on the S&P. It also gave a buy signal on the 2 times bullish ETF on the S&P, the SSO. Notice that the Dow Jones Industrial Average has been on a buy signal since October 6th. Additional, there's the NASDAQ. It's on a buy signal since October 4. The QLD, that's the 2 times bullish ETF on the NASDAQ, has been on a buy signal since October 6th. The Russell's been on a buy signal. Well, it was on a buy October 3rd, and I would suggest getting out of the trade on October 6th. It hasn't been quite as bullish. A new buy signal tonight on the energy sector, ETF, XLE. Still no buy signal on the financial sector. There was a buy signal yesterday on GDX, and so on and so forth. No additional action items tonight, I don't think. But most of these things aren't very recent buy signals, except for, of course, the US dollar index, which I think is the linchpin that's driving the markets today. We'll talk about that in a second as well. And it was in a buy signal, and it exited that trade. Is now flat. It has not given a sell signal as of yet. But the euro flirted with a sell signal, but it got stopped out, as I recall, or exit signal on the 5th. It's flat. The only real recent buy signal among the currencies or sell signal is, in fact, the Australian dollar, which makes sense. It is a metals currency, and generally the Australian dollar is highly correlated to metals. So it's very much a mining economy in Australia. So those are the action items. So you get a summary report. Notice if it's a futures contract, you also get the DSI. So right at the moment, 56% of retail traders are bullish on the S&P, and we just got a buy signal. And so that means we're not overly bullish or bearish at this time. It's got plenty of room to move further higher. Same thing with the NASDAQ. Our DSI is a 58, German DAX of 50. Bonds recently were far more negative than this. They're at a 20 right now. Crude oil's back to 59. So on and so forth. Gold has we got a buy signal yesterday, and the DSI is only 31. It's still quite low. So this has potential for a large amount of upside before the DSI gets too high for it. Same thing with silver. So there you can learn a lot, and from the nightly report, just from looking at the signals and the sentiment. But it also lists a short description of my current Elliott wave count and what Hurst cycle analysis, the direction that it thinks is going to happen next. So, for instance, we looked at that Australian dollar chart, and if we look down here at the Australian dollar, the cycle analysis is expecting upward movement from early October 2023 through approximately mid to early December of 2023. So it's expecting it to move up for the Australian dollar to move up for a couple of months. So let's look back at the Australian dollar. 2 months of upside coming out of a fairly low juncture, and it's very much supported by the sentiment conditions, everything. There's the potential for a large degree of upside in the Australian dollar over the next couple of months. But anyway, there's a quick look at how to examine the sentiment. And one additional thing I'll show you on the that's on about 20 different, the most popular 20 different items. But we also, for premium plan members, add an additional over 20 screenshots every night that shows sentiment as well as seasonality on about over 20 different commodities. Sentiment and seasonality, the combination of those two things, I think, are extremely powerful, especially in the commodity complex. And the reason is, in commodities, you can tell, it's very easy to determine exactly who the commercials are. The commercials in the commodities world are the producers. So that would be the copper miners. So when the copper miners are extreme, and let's say you owned a copper mining company, part of your business, and a very important part of your business, would be you would have a very large trading account for the purpose of hedging in case the commodity that you were producing, the price took a dive. So in other words, if you thought that copper was going to move down, you would want to be positioned as a commercial, as a copper producer. You would want to be positioned short. And that would hedge your business interests. It would protect your business interests. And that way, if copper did drop like it did right here, notice the commercials are all heavily short right here, and the commercials were, as they almost always are, that correct. The price did move down in copper at that time, and but most recently in copper, notice we have some big green boxes showing up over here, and commercials all green. In other words, the commercials has a percent of open interest, heavily long. That's a Larry Williams concept that he wrote about years and years ago, and decades ago. And he even put the code in his book at the time, on how to program this custom indicator into your Trade Navigator. And this is the platform he was using at the time, Genesis Trade Navigator. So I got that right out of his book. And then a more typical commercials measurement is, how are the commercials positioned right now in comparison with their most bullish and bearish positioning over the last 6 months? So right here, commercials were as bearish as they had been at any point in the last 6 months. But right here, they were as bullish as they had been at any point in the last 6 months. And that's the 6-month look back. And I call these the fast, medium, and slow acting commercials positioning indicators. And in this example, this is the 12-month look back. So once again, here, commercials were as short as they had been. In other words, fully hedged against lower prices as they had been at any point in the last 12 months. And then here, they have been gradually taking off their hedges because they don't think copper is going to move lower at this time. So they have taken off a lot of their hedges at the same time as retail traders got down to a very, very negative level on their sentiment. Only 12% of retail traders were bullish at this low. And that creates, and so what I do with this is I take the DSI indicator and I make a 3-period simple moving average of it. And then I have the computer color that red or green, depending on the slope of that smooth daily sentiment average. So right now, starting right here, it started sloping to the upside. In other words, the 3-period moving average was higher, closed higher than it did the previous day. And so the color of that smoothed DSI line is also mimicked in the color of the candles in this sentiment conditions proprietary uh, template that I use. And so right here, that candle right there was a bullish engulfing candle following a red candle. And so that was really the most convincing start of what was likely to be a perfect storm of bullishness, and that occurred only 3 days ago. Also, notice the bullish seasonality. So it's really kind of a perfect storm of bullishness. And if all the metals are going to be moving to the upside, then we'll go back and look at the nightly report on the U.S. dollar. Let's see what it's saying about the U.S. dollar here. Sentiment. Okay. This is huge right now. Notice that the commercials are positioned heavily short the U.S. dollar on the fast and the medium acting speed acting commercials positioning indicators, and they're getting short fast on the 12-month look back as well. This is all occurring at the same time as we had a 93. So on this date right here, 93% of retail traders were bullish on the US dollar. So anytime you get one of these pink stripes down here, that means that it's in single digits. It's either above 90 or it's below 10, and in which case you get a green zone. And you get a green arrow underneath price, a large green arrow. But when you get the big red arrow, that means it's above 90, the DSI. And by the way, the daily sentiment index rarely on any item is ever higher than 93. So once again, we had very close to a fully bullish storm that had brewed up in late September. And amazingly, the US dollar found one more slight new high, kind of a last stop hunt before it has started moving to the downside. So the conditions are bearish, the US dollar. The bearish dollar has been moving to the downside. And when it does that, all assets are propped up. So any asset, and I would include stocks in this, stocks or commodities generally, is going to look, if the US dollar index is in a downtrend, it's going to make assets look like they're going up. And it creates a trading opportunity if you're seeing the US dollar moving to the downside, turning like this, moving to the downside at the same time as you're seeing metals and stocks turning and moving to the upside. So that's the US dollar index sentiment. Let's see what it's offering up on the automated signals. Okay, it's not shorting yet. And the reason is because this adaptive moving average, this is Perry Kaufman's adaptive moving average, it has flattened out, but it would need to start sloping to the downside. As soon as that turns red, a dark red, like it did right here, then we're in position to get a sell signal. So these signals on the algo need two things to happen. Number one, it needs the slope of the adaptive moving average to agree with the trade direction. So as long as this has been green, this algo has only been taking long trades. In other words, it's trading with the trend. This indicator down here I call the Walter Bressett, and it is a double smoothed RSI. That's this darker line down here. In order for a trade signal to occur, the crossover of the Walter Bressett with a moving average of it, in this case, a 19-period moving average, 19-day moving average, they have to agree. So you can see right here, we got a negative crossover of the Walter Bressett and its moving average right here. Whenever you get a crossover down here, you get a red block, and it also appears up here, which you can see here. So that, as it turns out, was effectively an exit signal. So you can see it only buys if this line is green, and it got a buy signal here because it got a green Walter Bressett crossover, but very quickly it got a negative Walter Bressett crossover, and that was its signal to exit. In other words, what the algo does is it waits for agreement of these two indicators before it takes a position, but it will exit on the fastest acting of those indicators. So for instance, right here, we had a green adaptive moving average, and we had a green Walter Bressett crossover. That was a buy signal. The buy signal came in at the close of this candle, and it bought at the open of this candle. And it stayed long. And then on this day, notice that little red arrow above price. That meant that the Walter Bressett had started sloping to the downside. It was just based on the slope. That was a warning to tighten your stop. Start trailing the stop, which it did do at that time. And that is why, and then on the very next day, it got a negative crossover in the Walter Bressett, and it said, no, just get out, take profit, lock it in. And that's the way the algo works. Some additional things that the algo takes into consideration are and this is all based on backtesting. By the way, the settings of the adaptive moving average, which in this case are 10, 6, and 30, are all backtested and optimized over the last 3 years of data. And I just got through backtesting. I hold this quarterly webinar as soon as I get all the quarterly backtesting finished. And that usually takes me about a week to backtest and optimize everything. And when I do that, I look at the last 3 years running. So the settings here, and the setting, the Walter Bressett never changes, but the moving average of it is back tested. Also, I check for a filter. As a filter, that if the DSI, the daily sentiment index, is too high, it won't take a new long trade. And if the daily sentiment index is too low, then it won't take a new short trade. In other words, it will not continue to trend follow when the DSI gets into nosebleed territory. Now, in the case of the US dollar index, there really is no filter as far as bullishness. It would have to be above 98 based on backtesting to not take a new long trade. But anytime the US dollar index is below 26, you'll get these little green blocks or green thin squares around price. And that means that based on backtesting, it's not going to take a new sell signal if that condition persists, because it hasn't paid off well. the odds are against it moving lower based on the last 3 years of data. And you'll notice that it refused to short it here. It refused to take that short. It refused to take that short, and it refused to short here. It just simply kept refusing to take a short because the DSI was low enough that it just didn't backtest well for it to continue to chase it lower. And then finally, the third indicator down here really has no bearing on the algo other than it's an additional indicator that I think is worth putting on the algo charts. And this is my custom money flow index versus RSI indicator. The black line is the RSI. The blue line is the money flow. When the black line is above 70, that means the RSI is overbought. If the money flow indicator is below the RSI while the RSI is overbought, that is a sign that the trend is nearing an end. And so it throws up, and the most powerful signals it throws up are the dark red, which says to watch out. We're running into a lack of buyers here in this case, or dark green, watch out for a significant low. And you can see how accurate those have been on this chart. Any questions from the gallery about how my algo works or how my sentiment conditions screenshots work? Those are the two big things that premium plan members get that none of the lower tiers get. Does anybody have any questions about the algo, how it's built, and the sentiment indicators and what those indicate? Okay. If you can think of something, throw it into the chat. I'll try to address it. There's a couple things I wanted to show to you, and you can check these. By the way, my YouTube channel, which is where the recording of this webinar will be placed, is called Elliott Wave Plus. And we have a number of recordings there going back several years. And the most recent one right here was the quarterly premium plan webinar. And of course, there's an ad comes up, but I made a couple of screenshots from that webinar that I wanted to show you. And for this, I'm going to get away from the website. I'm going to get back to the live charts. And first thing we're going to look at is the US dollar index that we were just following. Just looking at the current sentiment conditions as well as the current any algo signals, momentum algo signals. And so we're going to jump to the currencies section. Okay, here's the US dollar index. Here is, and I took this screenshot directly from the recording from 3 months ago, the quarterly premium plan recording for 3 months ago. This was my Elliott Wave chart that I showed during the webinar on the US dollar index, and I felt like it had just bottomed. There was a number of reasons why. A large cycle, 20-week cycle, Hurst cycle trough was due. It had stopped going down right in a Fibonacci target zone, and my count at the time is that we got 3 waves up for wave A. This is after a 5-wave down structure. 3 waves up for an A, 3 waves down. This would be a double zigzag, a WXY double zigzag, to a slight new low. there in mid-July, and that we would get a five-wave structure to the upside. And my target, initial target was 107.88. Somewhere between mid-August and mid-September at that time was where I thought it would peak. So anyone who was in the webinar last time would have been given that incredibly valuable Elliott wave chart. And here's what happened. So that quarterly premium plan was on July 21. It occurred right here. And I was projecting it would go to 107.58, 88. Notice that that Fibonacci target is still on my chart. And I was expecting a five-wave up structure to come pretty close to that Fibonacci target. And that Fibonacci target was on a Similog chart. You measure the distance of this initial wave to the upside. You take and consider that a unit of 1 and take that times 0.382 and add the sum, the product, to the top of the wave A. In other words, and this is a target where wave C would be a 0.382 expansion of A. So we take this as a 1, we expand it 0.382, and we get that target. So that target is still on there, but as we're moving up on the US dollar, I could start counting where the waves were. And I've counted as a 1, 2, 3, 4, 5, and I've gradually, for subscribers, added like the trend channel. This is the Elliott RN Elliott trend channel, where you connect the extremes of 2 and 4 of the impulse and put a parallel copy intersecting with 3. That gives you a kind of a resistance upper idea where you would it would see resistance at the upper portion of the channel, and then it also and I left that on the chart as it looks like we are breaking down. Matter of fact, today we did close slightly below that trend channel. So I integrate in Elliott Wave and its associated Fibonacci price targets with Hurst. Notice that I was expecting this to be a 20-week cycle trough low. And I was expecting it ahead of time. So that date right there, the bottom date was July 14. So what I'm going to do is I'm going to bring over my OneDrive account. This is everything we post for our subscribers, all in a single folder. And that was July 14. So I'm going to let's see what I was thinking on currencies. A few days before that, July 12. Okay. Well, I was expecting the US dollar index that it would move down to 100.24. It would do it approximately by July 13, and then we would see a rally up through at least August, and there's that same target. So I was calling for that low before it happened. Now I got to tell you, when this occurred right here, when it was, and the US dollar was puking out hard, I was getting emails from subscribers like, whoa, hey, Sid, we have a breakout. The US dollar has broken out below the low that occurred back here in whenever this was, in January, something like that, late January, early February. But this is a breakout, and this could keep going lower. And my answer was, no, I don't think I think it's a false breakout, because a 20-week Hurst cycle trough is due in mid-July, and therefore would expect, all things being equal, at least a 10-week rally out of the whatever low it put in July. That's why I was very confident that this was not going to be a 1, 2, 3, 4, 5 on down at the time. It was simply going to be an ABC, and it was going to stop going down basically when it did. So 100.24 was the target on that day, and it actually got down to 99.58, which, by the way, had wave B being a fairly common 1.236 times the length of wave A. So this would be an expanded flat. A, 3 waves up for A, 3 waves down to a slight new low for B, 5-wave structure to the upside, to most likely above the level of the wave A. It would be an expanded flat. So you can see it was incredibly important, and that what the message that Hurst cycle analysis was bringing to the table. And this is what separates my work from anyone that is Elliott Wave only. Okay. Uh, what else? What else did from last time turned out pretty solid prediction? Well, there's crude oil, and we're going to change to oil and gas. There it is. And then we're going to get back to the screenshot from the webinar 3 months ago. So 3 months ago, and that's the US dollar. Let me bring up crude oil. Do I have it? Yeah, here's crude oil. I felt like the very same pattern was happening in crude oil. We had seen a nice 5-wave down pattern in crude oil down through approximately mid-March of this year, and then a wave A and an ever so slight new low for wave B. And so I was thinking at the time, well, here we go again. We're getting expanded flat, and this would be a wave 1. This ended up being a wave 2. Then we get a 3, 4, 5 on up, and I had target zone up here anywhere from 91.65 to 99.62, and there were several Fibonacci's in there. And I was originally thinking it would move up through mid-August based on Hurst. Whoops. Here we go. So what happened? Well, it worked out as a 1 and a 2, and then it finished a 3, 4, 5, and it peaked out at 95.03. Completed a 5-wave structure, and now it has started moving to the downside. And yes, we have this new stuff in the Middle East, but the war there, which is very unfortunate for loss of life. But I don't build my wave counts around news events. I just don't. And I think it's a huge mistake to do that. I think when the war broke out over the weekend, a lot of people were writing articles and talking about how this would be very bearish. It might be bullish for crude oil, but that's about it. But the stock market has gapped up and gone up big every day ever since. And we'll talk about the stock market here in a second. But anyway, this still has the possibility of putting together a 1, 2, 3, 4, 5 to the downside. Not sure. But the thing I wanted to point out was that webinar occurred right in here in mid-July, and it went ahead and unfolded exactly as I thought it should. And that was based on a number of factors, not the least of which is that there was an 18-month cycle peak due pretty soon. Now, it did take a little bit longer to peak and top than what I thought, but it moved it did respect the Fibonacci target zone that I'd set much earlier. Okay. So I've showed you my website. I've showed you my different services and what we cover. I've showed you some good trades and that I revealed for free on this webinar 3 months ago that worked out very well. And we've looked at a live chart on now on crude oil and on the U.S. dollar. So I'll take requests now as far as what you would like, what items you'd like to see the current conditions on. So anyone that has any items they'd like to request to see my current coverage, I'll show you the sentiment. I'll show you the automated signals. I'll show you the Elliott wave count. So please use the chat to do so, the Zoom chat. Any requests? Okay. Silver, semiconductors, gold. Okay. Well, S&P, very good. The biggies. Let's start with the S&P. I don't have anything on rig there, Vivian. Sorry. I do have some individual stocks. Most of them are, the FANG type stocks, Apple, Amazon, NVIDIA, Google, Microsoft, Tesla. The huge volume stocks. I've got Amazon too. Okay, well, let's start. Before we start the individual coverage, I do have one more very important thing I wanted to show you. After we do all our back testing on the algo, this was what we call the sortable spreadsheet. This is a live Excel sheet that ranks on a 3-year return on investment. It ranks all of the algos based on their performance over the last 3 years. Had the current settings that I'd established in July been in place for the last 3 years. Then the leaderboard here 3 months ago was the euro and gold. And what that means is the euro and gold were the smoothest trending items. Notice that the stock market, like the Dow Jones and the S&P, they were down the list last time. And so I've been telling people, hey, I know most traders are addicted to trading the S&P, either with ETFs or leveraged ETFs or the ES contract. But if you're going to use my algos, why would you trade the S&P? It's down the list. You want to trade euro or gold. And this was in July of last year. Here's the current list now after the new backtesting optimization. Gold is on the top. Dow Jones Industrial Average has moved up very close to the top. This is a 3-year return on investment. In other words, those algos trading one contract at a time on every signal, had the current settings been in place for the last 3 years, would have made $95,000 in gold profit in gold, $75,000 in Dow Jones Industrial Average. And in the case of gold, during the 3 years, there was a period where it had 7 consecutive winners, and the most consecutive losers it experienced was 4, and that puts gold in the number 1 position again this time, or very close, with the Dow Jones close. Notice the S&P; it's on down the road. I'm telling you, and I've been watching this price action for a while. The S&P is overly noisy in comparison with trading the YM contract. So I know a lot of people are addicted to the S&P and they hate it when I say this, but it is not the best trading item or the smoothest trading item to trade at this time in the markets. Gold has been near the top now for 6 months, whereas and the Dow Jones Industrial is second. Amy, I have a number of educational videos at my site. Go to my site for that. And you'll find, as far as how I count waves, how do I establish my wave counts? That is a complicated question, I got to tell you, and it's and there's a long learning curve on associated with learning to count waves in Elliott Wave. In my opinion, you have to read Prechter's book, probably the first 100 pages, 3 times in a row and take solid notes. But yeah, you go to my site, go into resources, you got videos and guides. One of my favorite guides, I did this years and years ago, that's in here. There's all kinds of information about well, I used to have it in here. I used to keep I don't know where it is now. Oh yeah, here it is. Guide number 2, Elliott Wave Explained, an outline of the wave principle. So when I was learning Elliott Wave 20 years ago, I took copious notes and I made an outline. And so this is basically a short, like a Cliff's Notes version of the wave principle. And if you printed it out, it would probably only take about 6 or 7 pages. So please go here. This is under resources and guides. And it's guide number 2, Elliott Wave Explained, an outline of the wave principle. And there's other information there on videos and things. And I even have videos about how I integrate Hurst cycle analysis with Elliott Wave. I must tell you, in my opinion, there's a reason why I added Hurst cycle analysis to my toolbox, and it'll be there forever. And that is because I'm way more accurate wave counter now than I was before I had it. I think Elliott Wave is lacking a final and very important timing element to it. And it is really fabulous in many ways, and I love the Fibonacci targets and things, but they only work if you have a correct wave count. And when you start marrying Elliott Wave with Hurst, which is what I do, I wouldn't expect anybody else to do it. To be able to do it, frankly, it's a full-time job. In order to see the best, I think the way they work together and also sentiment, extremely important. Some people trade just on sentiment alone. You just have to subscribe. I'm sorry. You just have to subscribe to my work, at least to the basic level. That's the $70 a month level. I would recommend higher, but I wouldn't expect much out of the $25 level. So I'm getting back to my analysis on so I'm going to show you my wave count, my general idea on the Dow Jones Industrial Average. And the reason is because it's the better item to trade right now than the S&P. The S&P continues to be extremely noisy. And the swings are smoother in the Dow Jones. So long-term concept. I don't think we have a major top end on the stock market on Dow Jones Industrial Average yet, because there's the three large degree Fibonacci targets that up there that have not been hit yet. They're between 41,020 and 43,652. And that is a extended fifth wave target here for the end of teal or cycle degree wave 3. So 1, 2, 3, 4, and a massive fifth wave. Very extended, but not beyond what can happen from a Fibonacci standpoint. Also, a Fibonacci target of about 42,000 on the Dow for the end of a normal wave 5. So 1 in burgundy, 2, 3, 4. Burgundy is primary degree. And then a normal wave 5, where wave 5 would equal, and this is target I always use on a Similog chart, must be on the Similog chart, and the Fibonacci tools must be using Similog math. And I can tell you, Thinkorswim doesn't do it, doesn't have it. It requires a more frankly, a more sophisticated charting platform, and I use Genesis Trade Navigator. So the fifth wave target of 41,981 would be where you would get wave 5 in burgundy times the net travel to 1 through 3 burgundy times 0.618. And then looking for a fifth wave target up starting at the 2009 low. 1, 2, 1, 2, 3, 4, 3, 4, 5. And the best target for the end of the fifth wave is 43,652 in the Dow. And that is where wave 5 would be, once again, be the most normal, 0.618 times the net travel to 1 through 3. So as we move to the monthly chart, there's that Fibonacci target zone. You'll notice that that high that occurred in January of 2022 fell short of that. And then here's another really, really important thing about the rocket ship move up out of the March of 2020 is I believe that it counts best as a zigzag, not a 5-wave structure. There are certain Fibonacci relationships that need to appear in a 5-wave impulse. And it just didn't happen. A lot of people are calling this the fifth wave up. So like 1, 2, maybe 3, 4, 5. I'm sorry, but the Fibonacci relationships between A and C of a zigzag are the ones that work on that move to the upside, not a 5-wave structure. So 1, 2, 3, 4, 5 for A, and then B, and then 1, 2, 3, 4, ending expanding diagonal for 5. And wave C and the Dow was almost fell ever so slightly short of being equal to wave A. So if this was an ABC zigzag and it traveled 80% of the way to that target zone, then I figure that this must be wave 1 of an eventual ending contracting diagonal. Each leg of a diagonal is typically an ABC zigzag or something from the zigzag family, a double zigzag or maybe even a triple zigzag. I think this wave 2, which isn't finished yet, is carving out a double zigzag. So A, B, C for W, A, B, ending contracting diagonal for C for X, and now an A, B, C to the downside. Hurst analysis thinks that the stock market is going to be able to, quote unquote, stay up until early December at this juncture. And then we get our kind of devastating move to the downside that would be associated with a very sharp, quick recession down through approximately the middle of next year. Each leg of a diagonal typically retraces the prior leg by 66 to 81%. And that, so the target zone, actual target zone for wave two is way down here. I don't think it's going to go down there, because if this was wave W, a 0.618 expansion of pink wave W would be at 24,495. So my target for the Dow Jones Industrial Average by the time we get to early June of next year, if Hurst is correct, is 24,495. I think we're going to get a rebound here. In other words, a rally during the fourth quarter as per typical seasonality. And then for whatever reason, we get a pretty nasty pullback. And that pullback would be as large as 30%. 30% in the Dow Jones Industrial Average. Then there would be a really amazing buying opportunity here at 4.5-year cycle trough nets. And by the time one full year is passed after that mid-2024 low, I think the market's going to be back to all-time highs. I think this low is going to be bought like crazy. One additional thing I'll note is in October of 2022 was the first time we saw the 3-month and 10-year bonds invert. There's typically a 6 to 18-month delay from that inversion to the start of a recession. So we're just barely past halfway in that window. There's plenty of time for a recession to start and to still be normal. That's what's hilarious about all these people, coming on TV constantly saying, no, I don't think we're going to have a recession at all. That we're going to have no landing, or it's going to be a soft landing. And that's what they were all saying about right here. And then right here, they were getting all worried and saying, boy, yeah, maybe this is going to be a hard landing, and all of that talk on financial propaganda TV is worthless. Another thing that's worthless is that anyone who says the reason why the rates are going to go higher for longer is because the Fed said so. The fact is, the Fed does not set interest rates. They change their interest rates with a significant lag from what the natural market does. I mean, you look at how long it took them to start raising rates. They weren't pushing rates higher. It took them a year and a half to respond to interest rates moving higher. And then they had to catch up. And for anyone to actually sit there and say they are driving the bond market, I mean, we just saw absolute proof that they do not. I'll tell you what they are good at. They are good at jawboning. Talk. And so many times what they have to say is wrong. So here's the daily chart on Dow Jones Industrial Average. There's nothing impulsive about this move up in the Dow Jones Industrial Average. If from the October low, and let's say that you wanted to be really bullish and you wanted to count this as a wave one, then you probably count this as a wave two. Well, where's the wave three? Where's the wave three character? As a matter of fact, now we have dipped back well below the wave one. I think there's still a chance that we get a one more slight new high above for the year, above the August 1 high in the Dow, but I think it's become pretty remote now, especially when you consider that this move to the downside, I think was a pretty clear 5-wave structure down in the Dow. 1, 2, 3, triangle for 4, 5. Done. So that's the end of 5 waves down. And of course, we're getting a bounce, no matter what kind of news flow is going on. And Hurst, you can see that Hurst thinks that the stock market's going to stay up all the way into early December now. And frankly, it's been pushing these dates a little bit further and further forward. Why would it do that? And the reason is because each cycle trough low is taking a little bit more time. It's expanding time out. Why would it do that? Because we're in an ending diagonal. It takes a long time. You know, typically major stock market tops, they don't happen in a peak and then you just get a crash. They happen in a very gradual, jagged way. So many times the stock market tops in history, major tops, have been rounded. Whereas it's the bottoms that are the spikes. So yeah, that's this ending diagonal count and the fact that the cycles are running the shorter cycles a little longer and a little longer. Um, well, uh, I'm trying to answer. I guess your name is showing me as Christy. I don't know if it's Christian or what it is. The question. So, is this too much of a rise for the wave X of a double zigzag? No. As a matter of fact, I suppose if this was 3 waves down for a W, it would be possible in a double zigzag for the X to actually make a slight new high above this high. I don't think it will. But no, there's nothing about this wave count that's to be. If you think that this rebound should have stopped at 0.618 or something, no, that is not the way things work. 0.618 is kind of a guideline of where an Elliottician might look for the end of a bounce back. But no, there's nothing wrong with this count. Nothing wrong with it rebounding as high as it has after this initial plunge. I don't think it's going to make a new high before it plunges down into this move to the downside. Right. My wave count has 2 more years, a little more than 2 more years before it would eventually end. And it makes perfect sense to me that it would be a grinding, overlapping, ending diagonal in order to finally put in this very significant major top in the stock market, the end of grand supercycle wave 3. So you can take that Dow Jones Industrial Average and you can apply it to the S&P, the Nasdaq, and the Russell for the most part. What else is so you might go, well, were you expecting this low right here, Sid, that occurred in the first week of October? Well, I'll bring back um, the ways the back to the screenshots, and let's look at the screenshots on October 1. You can apply the same um, concept from the Dow to the S&P. Yes. I'm not going to give away everything tonight like I did last time. Sorry, Duke. Um, that's for subscribers. So here's what I was showing on U.S. stock indices on Dow Jones Industrial Average on October 1. I was expecting a 40-week cycle trough possibly here and a rally through late November. Bye, Duke. So this general idea flows perfectly to the S&P. How about gold? People who are addicted to the S&P, I'm telling you, it is an addiction. They're serious about it too. But it's not the best time to trade, and hasn't been for at least 6 months. It's too noisy. Okay, here's something I showed very quickly. No one asking much about bonds. But a lot of talking heads on TV talk about bonds like they're as long as bonds were going down, we were going to continue to get a bear market, and none of that talk. And then there's several billionaires that are saying bonds are going to continue lower. So if you look at the long-term wave count on bonds, this is on TLT. 1, 2, 1, 2, 3, 4, 3, 4, 5. I think that we ended 5 waves down in October. And then we got 3 waves up for an A, and now we're getting a B wave. Now the B wave in the TLT went slightly past where a theoretical B wave would end. But if you take the price action that has occurred since that very large cycle into that 5th wave down, according to my wave count, that occurred in October on bonds. And then you look at the ZN contract, the 10-year contract. So we got a 5 wave down structure. 1, 2, this is a daily chart. 1, 2, 3, 4, 3, 4, and then wave 5 down. Ever since that low, and that was in mid-October of last year, here's my wave count. 3 waves up for an A, 3 waves down for a B, and then a 5 wave structure up for C. So it started with essentially a flat. Then that would be wave A in blue. So this downward movement, I think, counted best as corrective. A, B, and then 1, 2, 3, triangle for 4, 5. So there's the first zigzag, an A, B, C zigzag of a double zigzag, then an X wave, and then an A, B, C to the downside for wave Y. There are 4 really tidy Fibonacci targets down here on bonds that were essentially hit a few days ago. So one is, if you consider this distance here of wave A, and you take that times 1.382, then if we were going to get an expanded flat, then wave B would move down to this blue line right here. Also, after this first zigzag down, A, B, C, and that was also a flat, we can immediately set a target where that would be wave W, this would be wave X, but after wave W is on, we can set a Fibonacci expansion target where wave Y would be equal to wave W times 0.618. That's that pink dotted line. And then finally, this final zigzag to the downside, A, B, and then 1, 2, 3, 4, 5 for C. Best target for the end of green wave C would be this green line right here. That's where wave C would be a 0.618 expansion of wave A on a Similog chart. And then finally, there's one more target here. And that is that if this was an orange 1, 2, 3, and 4, then the orange 5 target would be equal to 0.618 times the net traveled of 1 through 3. And that's this orange line right here. Such a tidy Fibonacci cluster. And we hit the pink target right in the middle of that target zone on Wednesday of last week and have been bouncing ever since. I think this is very likely an expanded flat. So A, B, and the next thing would be a 5-wave structure to the upside, all the way back to 120 area. So very interesting. We would get a bounce on bonds right here. Let's see if we take this bonds chart, and bonds are typically correlated with the US dollar. But they're basically oppositely correlated. So I'm going to turn that upside down. So there's the US dollar index. So here we have, and I already showed you the US dollar index, expecting a turn in the US dollar index. We're getting it. And so the US dollar, this green line, which is an inverted US dollar index, is has turned. As a matter of fact, and it's turned to the downside, the US dollar. I'm going to draw kind of a trend line there. So we have a significant trend line break that's just occurred in the US dollar over the last little bit. So this makes total sense that we get to see bonds moving up next, and that means bond yields moving down. So a lot of people say, well, if bonds are moving up and yields are moving down, why is the stock market moving up? And the reason the stock market moving up is because the dollar here over the last few days is I think the dollar's the linchpin for all of it. Dollar's been moving to the downside. Let's look at gold. Long-term gold forecast, once again, if we're going to see the US dollar moving lower, and I've already showed you my forecast is certainly going to move lower, and the next move would be lower on the US dollar through the end of the year, at least, and that would just be the beginning. Well, we're very likely to see certainly precious metals moving to the upside. So this is a very bullish forecast on gold. And you might look at it and go, well, what about this recent capitulation in gold? Isn't that a terrible sign? No, it's a very bullish sign because it was actually this needs to be like that. A and then A, B, C, D, E triangle for B, terminal thrust out of the triangle, very likely finished in gold. Here's a closer look at it. So in Elliott Wave, we have thrusts out of triangle. There's a couple ways to show a triangle here. One is the one I've shown. Another one is like this. I'll color these a different color so you can see. So here's a real key. After a 5-wave up structure, was expecting a corrective structure back to approximately the wave 4 of 1 degree, which is right there. So it started with a 3-wave structure to the downside, and then it went up, in my estimation, in 3 waves. And so it doesn't matter how you draw the triangle in there. There was a triangle and then a terminal thrust out of the triangle, and that apparently is finished. Very likely is finished. Terminal thrusts out of triangles are quite aggressive until they're finished, and they are the last move of a pattern. So I've got this, and when you look back here, I think it's pretty obvious this was a wave 3. This was a multi-year flat for wave 4. Now we've got a 5-wave up structure for 1 and a clearly corrected pattern. A triangle cannot appear alone in a wave 2 position. So this can't be a wave 1 and a 2 and much lower. And it wouldn't make sense for it to do that anyway, because the US dollar appears to have finished its corrective pattern and expanded flat. And if my wave count's correct on the US dollar, we're going to see a seriously weak US dollar for a wave 3 to the downside. It's going to affect everything. Let's see. I wouldn't. The U.S. dollar, in my opinion, is a massive short, and that means that the euro was asked about the euro earlier. I mean, notice British pound extremely bullish against the dollar. Euro wave count from that low back in October or late September of last year. 5-wave up structure 1, running flat for 2, 3, 4, 5 for 1, and then a 3-wave structure down for a W, a 3-wave structure up for an X. By the way, that X wave was 1.382 times the length of wave W. Very typical of an expanded flat. But in this case, because everything is in threes, A, B, C for W, A, B, C for X, we would expect an A, B, C to the downside. Once that wave A was labeled, was able to set a Fibonacci expansion target where wave C would be 0.618 expansion of A, and that's at 1.047. So that would be down to this orange line right there, and it appears to have gone straight to that target and has turned. This is very likely in the euro a 40-week cycle trough. That would suggest, roughly speaking, we're going to see 20 weeks of up next. Bitcoin, I wouldn't recommend as a trading medium at this time. Most people that follow Bitcoin will trade it in like Coinbase, something like that. And so they can only go long. Well, I think just Bitcoin has become kind of if the market's generally going up, Bitcoin should go up. In other words, it's a poster child for risk on or risk off. And Hurst analysis is suggesting the very same thing for Bitcoin, pretty much. as it is expecting for the stock market, and that is that it will stay up. It's not going to go crazy to the upside, but it will stay up through late in this year. And then the first 2 quarters of next year are going to be a substantial dive. And this staying up business on Bitcoin is going to be, in my opinion, very choppy and sideways price action. So I don't see much of a trade here. So I'm looking back. Let's look at some individual stocks and see if they're following along the general roadmap of the Dow Jones Industrial Average, for instance. I saw Nvidia, I think, and maybe Amazon as a request. Okay, Apple. On Apple, I don't think I, I think we essentially have a one from the inception of Apple back in the early 80s. One, two, three, four, and this needs to be a five-way structure of the upside up from the middle of 2016. So here's the mid 2016 low right here in May. One, two, three. I've got this as a four. And then an ending expanding diagonal underway. One, two, three, four. And now we just need a final zigzag A, B, C. So 1, 2, 3, 4, 5 for A, and then an A to the downside, and now we're getting an A, B, C up through late in the year. And then the first 2 quarters of next year, I'm bearish. You can see that their roadmap is um, quite similar to the roadmap in the Dow Jones Industrial Average. And that is that Apple will stay up. As a matter of fact, I wouldn't be surprised if that Apple might sneak a slight new high for the year. The high for the year right now was in late July. That was at 197.20. It could sneak up to ever so slightly above that for a B wave. And then we get a plunge on Apple during the first 2 quarters of next year. Um, Looking here, been going for an hour and a half. Correct, Amy? Let's see if these there was an ask about Amazon. On Hurst is bullish on Amazon through mid-December, and then it is bearish through the middle of next year. So on Amazon, I think we're on a way. I think we ended a large degree wave three in August of 2020, and we've been in a corrective structure ever since, and we're still in a corrective structure. So A, B, C for W, then 3 waves up for an X, and then an impulse down for wave A. Then we got a B wave, sort of a double top. It's possible that this might be a W, X, Y, X, Z for an A here. I'm going to take that 5 off. So an A, and then kind of a double top here for B. Yes, expecting Amazon to stay up through late in the year and then puke out the first 2 quarters of next year along with everything else. What else? It looks like that asshole that made the comment about S&P is gone. He's not on the list anymore. So I'm going to go ahead and made a laughy face in his response to me. So I'm going to go ahead and cover that S&P now that he's out of here. So here's the S&P. I'll just give you the daily chart. This is what I guess he got so hacked off over, that he didn't get to see that this chart is expecting the S&P to stay up until late November. So and then expecting a plunge down into the middle of next year. Very simple. And it is in fact quite similar to the Dow Jones Industrial Average. What else? Just a quick note I'll make this week or this quarter is is that I had on these previous quarterly premium plan webinars been offering the first month if you've never subscribed before for half price, but I have discontinued. I have discontinued that special, so there's no free trials, no half price on the first month anymore. So if you wish to subscribe, you may do so, and you can cancel at any time. I'm going to finish the webinar now. Thank you so much for joining me this week or this quarter, and we'll see. The calls that I made last quarter were quite excellent, and really my call that the market is going to stay up through late in the year still stands. Have a great week in the markets. If you have any interest in subscribing and you have any questions at all, you may do so. My email address is sid@elliottwaveplus.com. Have a great one. See you. Bye.